The whole point of investing is to protect your money against inflation so that you have enough money to live on when you retire. The trouble is, different types of investment behave differently according to whether the inflation is high or low, or whether there is deflation, which is the opposite, when prices are falling. Inflation is an important issue to consider right now because the Bank of England is thinking about whether it should review its target of keeping inflation at 2%. Outgoing Bank of England Governor Sir Mervyn King and his appointed successor, the George Clooney lookalike Mark Carney, have been talking about whether the bank should take more account of encouraging growth in the economy. This has got some alarm bells ringing, for the bank's current policy already requires it to balance the need for growth with the need to keep inflation in check. Modifying the bank's policy could risk the bank being seen as soft on inflation, which would have huge implications for all our finances. Mervyn King insists he's not soft on inflation. However, the bank's record of forecasting inflation has been poor. Generally, inflation has proved to be higher than the bank has said it would be. Now, the UK's most pressing problem at the moment is to reduce our £1 trillion debt mountain. The most effective way of doing this would be to restore economic growth. But there is another way. We could inflate away our debts, and there's a sneaking suspicion that's what the bank wants to do. How would inflation reduce our debts? We know that inflation increases the price of the goods and services we buy. For example, the price of a pint of milk rose by a third between 1999 and 2009. And that's happening all over the place. With inflation, over time, your money is worth less. And the same applies to your debts. Their real value goes down with inflation over time, making them easier to repay. Suddenly inflation doesn't sound so bad. But before you become a fan of inflation, bear in mind that with inflation, interest rates usually rise, making the cost of servicing a lot of debt go up. So what happens to investors if we get more inflation? Last year, 2 US academics, Kenneth Washer and Lee Dunham, published an article looking at the performance of the main asset classes in relation to inflation since the 1970s. Their findings are very interesting and relevant to UK investors. In times of moderate inflation between 1% and 2%, Washer and Dunham found shares were the best asset class. On average, shares rose 1.4% above the rate of inflation in each quarter when inflation was moderate. This is probably because companies can push through price increases on their products and continue to grow their dividends. Shares beat gold and property shares, although their returns were positive. Bonds did worst of all, losing money in real terms as they returned 0.5% less per quarter than the rate of inflation. In periods of higher inflation, the investment picture changes entirely. In quarters where inflation ran at more than 2%, there was only one winner. Gold returned an average of 3.2% more than inflation in these periods. Bonds again did badly as their fixed rate of interest is eroded by inflation. But property shares and other shares did worst of all. High inflation made their dividends less attractive and share prices fell, returning 1.4% on average less than the rate of inflation in the case of shares. These are challenging findings for investors. Property shares and ordinary shares only beat gold in periods of low inflation. And in quarters where there was deflation or falling prices, shares did surprisingly well. On average, they returned 6.5% above the level of deflation, which averaged at minus 0.7%. Deflationary periods were best for bonds, which returned 3.4% above the level at which prices were falling in each quarter. To sum up, bonds are a very poor defence against inflation, but shares actually do worse when inflation is high. Gold, on the other hand, is a brilliant defence against inflation, which is why there's been so much investor interest in the precious metal in recent years. Investors can only hope a growth solution is found to our debt problems. Using inflation to erode away our debts would hit all our pensions.